Good evening. This is Ken Long at Tortoise Capital. I want to take a look at the market conditions here on a swing trade basis and just highlight a few interpretations of how we're using the percent price oscillator or the MACD histogram as a way to supplement our read on the RLCO framework. So this is the daily charts market health check. The vertical blue lines are 10, 20, and 30. 40, 50, 60, 70, 80 days worth of look back. The horizontal red lines represent resistance levels and support levels that held on the way up, and which, if this market starts to collapse, become price targets on the way down. The sine wave looking indicator is the moving average of the slope of the 30 period regression line. So the moving 30 regression line slope. And that's scored on this scale on the left-hand side. Right now it's between 0.34 and minus 0.12. It takes a positive slope greater than 0.4 to be statistically significant as very steep. And then on the downside, minus 0.22. So these two green dots represent the swing highs of that oscillator. The blue dots are where it crosses this dashed zero line. And so when that slope is above that dashed line, then it means it's a positive 30-day regression line slope. This red dot was at the swing low, so I use that sort of as a quick check on the indicator. So this red dot was a swing low about minus 0.12. This one was at positive 0.14, and then you got this resumption. You can see the Bollinger Band River and floodplain in the usual way. Here's the 200-day moving average and the lava right here where it gets bad. And then the outer envelope of the Z3 Bollinger Bands, here are these outside red lines. The middle, of course, is a simple moving average of the 30. 10-period regression channel, 30-period RAF regression channel, lagged by a day. You can see we just broke out above the 30-period RAF regression channel, which suggests that this move is abnormal compared to the previous 30 days. And so we're on the alert that that could be the start of an explosive next leg up, or the exhaustion move outside of the channel followed by a failure and then a retest at the bottom of the channel. So the current slope of that 30 is now at this black dot. That's like on the end of this indicator, and that's right around 0.22. So that's not an abnormally steep 30-day slope. This is sort of normal. You have the usual Williams percent R to show overbought, oversold. Notice we've been overbought for most of the last 60 days, and these little pullback tests all became buy on dip opportunities. So now on to the percent price oscillator slash MACD histogram using the parameters 10, 30, and an exponential 5 moving average. And I've put a Bollinger Band around that. This will be updated to read a 30/1. I think that's a better Bollinger Band to use. I've neglected to fix that, so let me show you how you fix that in stock charts. Just come down to here. Oh, it should be 30-1. Sorry. That should be correct. Ah, yes it is. It should be a 30.1, so I'll have to contact customer support. So anyway, what we look at on this one is the zero line of the MACD histogram is the directional bias giver, right? So we take a look at this black line, which is the signal line. This red line is the 5-period exponential smoothing average, moving average of the 10-30 MACD histogram, or percent price oscillator in this case. So when the black line is below the zero line, then we have a directional bias to the downside. When it crosses to the upside, so here was a period where it got worse, went negative here on this move, then found support, and then did a crossover to the upside inside that Bollinger Band River, and then crossed the zero line. This was a signal to get long. The bias just shifted from flirting with the downside and then resuming. So this is where we're looking to buy breakouts, and that tells you to buy right here at S&P at about 245. And if you used Z2, you're still in the trade. So the MACD histogram or percent price oscillator improves on this crossover back to the downside. That means it's stalling a little bit, and that's the first leg, and you can see that that move is here, and this just little pullback. Now, I don't have a problem if you decide that that move was significant and you want to lock that in order to prevent a retracement all the way back to the Bollinger Band mean, which would make this a scratch trade approximately. So I don't mind you cashing that at the crossover and banking that leg. The key is now that the signal line is above the zero line, we have a long directional bias. So when you get a pause and then a recross back to the upside, you get a re-entry signal right here. So you are long. If you cash, you're back long here. And this is, you would notice that that is also taking out the baby dragon. That's an emerging dragon to the upside if we're using the RLCO framework, second generation signals. And so this works until you get to here and you get a cross to the upside. You could have added this position and then the crossover back to the downside and across the Bollinger Band mean of that indicator. This is a good place to cash a double scoop, and you were happy you did. Now, we don't really get another crossover. Maybe this is a crossover in here, and you could be long here with a stop at Z2, and if you did, you're still in the position. But if you didn't, this was another signal of weakness, a second leg of weakness right here. And then the indicator rolls over. You notice even the slope of the Bollinger Band River rolled over. But it came down and then curled back up, and you get a crossover to the upside above the zero line. This is an important re-entry point right here, that you get a resumption of that 1030 strength. So the 10 has now crossed back above the 30, and it crosses above the smoothed moving average, and it's above the zero line. So you have a long bias, so you buy this at 259, and you're happy. Again, with the Z2 stop, by now you should be at this red line, locking in that 2-day low of support. So with this breaking out above the RAF regression channel, this is a key moment, a critical state where you have, is this an exhaustion move, a parabolic? Well, the slope is not extraordinary, although the 10 is pretty extraordinary. And this is at Z3, and you've had 3 days in a row at Z3. This could be the start of a third leg. If this is leg 1 and leg 2, this could be the start of that third leg and a breakout to the upside. So the jaws are open to the upside. We can stay overbought for a long period of time, as we've seen. And so this is how the directional bias can come from this percent price oscillator or the MACD histogram and supplement your interpretation of market conditions that come from the RLCO framework. Now, a thing that has me concerned here as we start the third leg, as you know, I see 1, plan for 2, and hope for 3, so hope springs eternal. But at the same time, I notice these large expanding bars and the increasingly longer tails on the givebacks. I'm concerned, are we late in the trend or early? So I want to take a look for a moment at the XIV trade and just see what the uber nervous folks are looking at. So let me come down to XIV. And now what you'll notice here is the most recent MACD histogram uptick or PPO uptick above the zero line. So this was a signal to get long right here, and that's right in here. Awesome. In fact, the channeling signal told you to get long here anyway. Told you to get long right there. And then the MACD histogram to the upside tells you to get long here. But if you remember, the S&P was breaking out to Z3 and riding an expanding Z3. Here, you can see we've had a doji and then 2 large range sell-off days in a row and couldn't make a new high for the third day in a row, second day in a row, if you will. And we're right on that the SAR stop here. So we're right at a checkpoint, a control point, right at the edge of the river. And so the S&P looks a lot more aggressive or interesting or growth-oriented than the volatility traders who are already cashing the gains from this leg, which was, to be fair, buying it around 103 and cashing it around 120. You'll recall our Spider Sense fired in the chat room, and we cashed up here around 121 from this leg. And I'm waiting to see how good this pullback is, or is it time to revert back to the long-term mean? But meanwhile, there's a divergence now between the S&P and the volatility that's of concern. So I want to check I'll just check IWM real quick as the trading vehicle. See if we can find him in here. There we go. IWM, the Russell Small Cap. And this is somewhere in between the S&P. So it's had a nice bump just like the other two, the index and then the VIX. And it had this first day a surge just like the S&P, a doji, and then a continuation. But you'll notice that the traders had a lot less follow through today than did the broad market of the S&P. So I think that we have the odd position here of the conservative broad market being more enthusiastic than the traders and the VIX. Now, what I'm going to bring in here just for a minute, got the risk Z indicator working, and so now what I want you to notice is that we've had a nice double bottom in risk Z, and just went into the upside. So this is a favorable indicator here for swing trades, that we're still early in the upward swing, so that's looking okay. And so I'm cautiously optimistic on the swing side. I am not carrying XIV positions overnight because of the weakness in that index, but I am carrying swing positions in the broader markets overnight to get the intraday bump, or the gap opening bump. And then I'm looking to go turbo intraday with XIV until this volatility starts sorting itself out. So that's what I wanted to talk about today. Understanding how the MACD histogram or PPO indicator can help supplement our interpretation of things here. And I did notice that EWC was a big percent loser, and yeah. So here's one where I love the swings in XIV. And here's one where it's pushed down to the 200, came back to the Bollinger Band mean at the 30, and then has rolled over here at a height less than, so that's a collapsing dragon kind of an approach, and has had a doji and two big sell-offs. So now if we hypothesize support here around 37.50, a resumption here to the upside is actually a favorable thing, because you have a higher low if this holds. But if this fails, then it's going to come down and test 37.50, and if that breaks, then it's Katie bar the door, because then this support here will have broken and the downside is available. And that could be part of a broader rejection of additional growth opportunities here, that maybe the market is overly valued right now, or overly priced, and it's time to cool off. And that's what I think is contributing to the nervousness in the volatility. But the broad market itself, the S&P, the U.S., that's the global trade right now, is people buying the U.S. as a safe haven, and tapping into the economic strength and growth that's there. So that's everything I wanted to talk about tonight. Keep your risk measured and your powder dry. Guys are doing a great job in the chat room, and we encourage you to come check it out. Take good care. Keep your risk measured and your powder dry.